Hey guys, it's Max Convexity here. I got Jax by my side. I got a great video planned for you tonight. The name of the video is Why Do These Funds Suck So Much? Why don't these funds take defensive positions? Why don't they use a stop loss? Why don't they just not sell a put whenever it looks like the market's going to crash the next day? Well, there's a reason for all these questions, and there's a reason why they don't do any of that. And I'd like to talk about the general theory behind it. There is one fund that is an exception to this rule, kind of. If you stick around till the end, I'll tell you which one it is. It's a fund I like quite a bit, too, so stick around. We'll get right into the middle of it. I got a comment here. It said, once again, with the loss of millions in QQQY and JEPI, reminds me of my previous controversial question. I believe today was a roller coaster day and pretty obvious that they either make a big profit or loss. This commenter was talking about the day 2 days ago whenever we lost a lot of money, whenever the indexes dropped. Like, I think the IWMY dropped 2% and all the indexes were down big and all of the covered call funds lost gigantic. There was a number that came out at 7:30 in the morning. I think it was CPI or PPI. I can't even keep up. It doesn't matter, but the number was interpreted bearishly by the market. So when the market opened at 8:30, an hour later, the market was already down huge. It had been too late to get out anyway. These funds, the Defiance ones I'm specifically talking about, they sell a put the night before on the close. So by the time the market opened, they were all underwater, millions of dollars. And so this commenter has the question, a fund manager with common sense should have put a stop loss or some risk management system in place. It's great to have a beautiful strategy, but where's the risk management? Seems they ignored this part. Max, please share your thoughts. Okay, yeah, it's a great question, and I promised the commenter I would share it in a video, and I want to turn this into a video. There is a reason. It's not just that these guys don't have common sense or whatever. They adhere to a philosophy that we're going to talk about tonight. And it's not just them. I would say 80% of Wall Street adheres to this philosophy also. It's not something that Defiance and Jay do and the other ones don't. They all adhere to the philosophy of the random walk theory is what I call it. It's also called indexing. And here's Norman's one of my favorite commenters. I like Norman a lot, and he made the same point. He said when they know the announcement is coming, this was the night before, I think it was producer price index. Why didn't they just not, do a position that day? And it's a valid question. The next day is going to be super volatile and, just stay out. Don't sell puts that day. It's a good question. And then the same commenter from the other question said, it's high time to question the fund managers and make them perform what they are paid to do. Managing rather than letting these funds go haywire. Also, I agree that they have to let go of trades or use stop losses. Oh, and he was agreeing with the prior commenter. Okay, and I'm not disagreeing. I'm not trying to pick an argument. I'm just going to explain why they don't. Okay, it all began with modern portfolio theory, and this is a theory that came about in the 1930s. I believe his name was Markowitz. He ended up winning a Nobel Prize in economics for modern portfolio theory. So modern portfolio theory measures portfolios and the components in the portfolio. In other words, if it's 60% stocks and 40% bonds, what they look at is not the return of stocks and the return of bonds. They look at how they perform together, and they look at the return they give you along with the level of diversification they give you. They look at what's called risk-adjusted return or Sharpe ratios. And I can't believe they ever used to look at anything else. I don't know what was before modern portfolio theory, but modern portfolio theory assumes that people are risk averse, assumes that people don't want risk, And what modern portfolio theory will point you towards is portfolios that do better on a risk-adjusted basis. If they have two portfolios and they both earn 10%, but portfolio A has twice as much volatility as portfolio B, modern portfolio theory would construct your portfolio like portfolio B. They're trying to give you risk-adjusted performance. So, and there is a criticism of it, and there's something called postmodern portfolio theory, which uses a little bit of a different measure of risk. But modern portfolio theory measures the variance of each of the components of your portfolio. So, if you're 60% stocks and 40% bonds, they measure the variance that those have. So they're saying that two portfolios that have the same level of variance and returns are considered equally desirable. One portfolio may have that variance because of frequent small losses. Another portfolio could have the same variance because of a rare but a spectacular decline. Most investors would prefer the small losses, and that is true. And that's a difference between modern portfolio theory and postmodern portfolio theory. Postmodern portfolio theory also takes in the gross size of the losses, the overall, how big the loss is on your portfolio as a percentage of the entire portfolio. So modern portfolio theory helps construct portfolios in a little bit different way. Still, nonetheless, neither of them would have got you. Neither of them, would have got you out of these covered call funds. The people that manage the covered call funds adhere to modern portfolio theory or postmodern portfolio theory, but they don't adhere to trying to time the market or jump in or jump out. So then modern portfolio theory got a hold in the 30s, and then in the early 70s, Jack Bogle came on the scene, and he was the founder of Vanguard. He's done more for investing and wealth management than anybody, probably even more so than Warren Buffett. In fact, Warren Buffett is a big fan of Jack Bogle. Jack was the man, and he invented the modern index fund. What these people that believed in indexing, what they did is they took modern portfolio theory and they took it to the next step. So Bogle's big deal was, even if you can pick stocks and beat the market, even if a manager is really talented and can get in and out of the market at the right time, if you have an actively managed portfolio, you have to pay for it. It costs more money. After you pay the manager his fee, after you pay the taxes, because you turn over a portfolio more when you're jumping in and jumping out. After you pay the taxes, the transaction cost, and after you pay the manager, most importantly, you don't come out ahead. In fact, you rarely come out ahead. There's been a jillion studies that have been out there, and these studies have lasted the test of time. I've read a million of them. I read one the other day. In fact, I just read one today, but it was behind a paywall, so I didn't put it in this study. But it was a Morningstar study, and it showed that this year they measure active versus passive, and this year active portfolios are ahead in 57% of the cases. It's 57 to 43 this year. Morningstar has some metric for measuring it, but active or passive always wins. Or I don't know if I should say always, but passive is usually well ahead over any period of time over active management. So Bogle thought that once you consider cost, it just doesn't pay to try to jump in and jump out of the market and time it. He Bogle was a big believer in not over diversifying. I believe Bogle had a theory that said you could be diverse with 3 funds. And I saw another study today that showed a way where you can be diverse as you need to be with just 2 funds. So over diversification can be a bad thing also. In 1976 is when it all started out. Bogle created the first index ETF, and it was pretty much it's pretty much what it turned into food today. VOO and SPY, and VTI, those total index type funds just rule the world. But the first one was 76. And it was pretty well received. It grew to a couple of $1 billion under management. Like I say, it eventually turned into the VOO. Warren Buffett is one of Bogle's biggest fans, and uses a lot of Bogle's philosophies in his own investing. People have other investors have compared Bogle's invention of the index fund to the invention of the wheel, to the invention of the alphabet or the printing press. The indexing is just such a central component to wealth management. Then in the early 70s, a book came out called A Random Walk Down Wall Street. And if you haven't read it, I would encourage you to. I read it in the 80s when I got into all this stuff, when I decided I wanted to become a professional investor, or become involved in the market. I read a lot of these books. This was a great book. And like I said, I would highly recommend you read it. So this carried the indexing and passive management philosophy a step further. And I remember about this book, it made a comparison of the market, of trying to time the market and read charts and, where you buy a pullback and then sell a rally and you look at overbought, oversold. The author compared trying to do that to following a drunk down the sidewalk. And the drunk is stumbling down the sidewalk, and if he falls off the left side of the sidewalk or the right side of the sidewalk next, it's anyone's guess. There's no way to predict it. And they think that timing the market is a fool's errand, and made a pretty good case. And that's basically the central premise of this book. And it's called the random walk theory. And the theory is stock prices are totally random and not predictable at all in the short term. So this had a big influence on me, and it had a big influence on a lot of people. I bet Jay Pestrochelli's read this book. I think we all have. Buffett, there's a famous Warren Buffett story. He was at an investing conference. I want to say it was like in 2010 or something. It wasn't a million years ago. I just read this story the other day. And they got into a discussion over active versus passive management. And Warren Buffett bet one of the hedge fund guys there $500,000 that his fund, or maybe it wasn't only his fund, it was that no hedge fund could beat the SPY over any appreciable period of time. And I don't know what their time period was, but I read within a few years after that, the SPY was ahead so much of the hedge fund that the guy went ahead and paid the bet off early and gave Warren Buffett his $500,000. I think he donated to charity, but it's a great story. But Warren's a big believer in indexing and the random walk, and I bet you Warren Buffett read A Random Walk Down Wall Street, or actually, he was probably good friends with the guy that wrote it. But it's a theory that is just absolutely decides pretty much how about 80% of money is managed. Okay, so these funds, these high yield funds, these are called actively managed. And that is true. They are actively managed, but not to the degree where they're going to try to get out before an economic number comes out and then try to get in the next day. A lot of my commenters want them to use stop losses and stuff, and I'm not picking on the commenter. It's a great idea. Maybe they should. Maybe modern portfolio theory is bunk. I'm just trying to explain the reason they don't. But these are actively managed to different degrees, because what they're calling the active managed part is the option overlay. So if you have, let's say you have QQQ, that is passively managed. They just own the index. Let's say you have QQQY. Well, they are actively managed because instead of owning the index, they write puts on the index. And they can vary which strike they write. They can vary how many, you know, units they write. They don't. They always just write whatever the money they have is. But that it is actively managed in the sense that they decide which strike to sell. And of course, selling a put every day gives you indirect access to the triple QYs. But there's different funds. I mean, the QQQY is not the only fund out there that does, you know, covered calls and short puts. That's a good fund. There's look at FEPI or look at JEPQ. We'll take them one at a time. FEPI, what it does, instead of owning the whole index by virtue of selling puts like QQQY does, the way they get access to the index is they own only 15 funds out of the index. So they try to pick the best 15 funds, and they just so they have more of a concentrated portfolio, and they sell covered calls on just those funds. So there's other ones too. There's the new Goldman Sachs funds, and there's the fund called BALI, which is the BlackRock fund. And they also adjust what BALI does. BALI doesn't buy the whole S&P index. Instead of having all 500 stocks, BALI has 116 stocks right now. So in other words, they try to pick the best 116 stocks out, and they try to generate a little of their outperformance by picking a better stock than just blindly owning the index. So that is definitely actively managed. Then in addition to that, BALI sells index calls, you know, and we've talked about selling calls a jillion times. You generate money because you're selling an option, and an option's a depreciating asset, and there's tons of studies that show you make tons of money over time. So they're generating part of the return from actually selling the option, but then they're generating the other component of the return by picking the stocks within their own little fund in a more active and hopefully a better way, you know, by overweighting the stocks they think are going to be better. But none of these funds are going to get short in a bear market. That's not what active managed means. And the reason is, I'm not saying maybe they shouldn't or whatever, but the reason is because they believe in modern portfolio theory, and they believe in the random walk, and they just believe you stay invested all the time, and you don't, you know, you stay invested in the broader market all the time, and the old a rising tide lifts all ships philosophy. All of these guys basically adhere to that philosophy, but they have little twists they do on it. Like I say, you know, FEPI only chooses 15 stocks for the underlying to try to get better performance. JEPQ, they also concentrate their stocks. They don't buy the whole index. They concentrate on the ones that they think are going to perform better. So they still generally believe in this theory, but they're trying to put tweaks to it. I think BALI's good. I think JEPQ is good. I think QQQY is good. But they all are actively managed to different degrees. There is a fund that you might want to check out, that if you want a fund that is actually going to get short if they see a down day coming, and they get long if they see, you know, there's actually going to try to time the market. There is a fund out there that I'm really interested in, and it's called RORO. And the way to remember that is the symbol, the ticker, stands for risk on, risk off. Now, what these guys do, and this is an old hedge fund strategy, and these guys have just turned it into an ETF, but hedge funds have done this forever. It's called long short, and hedge funds, for every long position they have, they'll have a short position. So hedge funds that do this philosophy try to maintain an overall neutral stance with regards to, they'll have, you know, half their portfolio long, half short, but they try to pick the ones that are long and pick the ones that are short, and do a good job of picking the funds right, where they get or picking what's long and what's short. They try to do a good job at that, and they get their excess return from that. So it would be considered a market timing fund. Now, I like mechanical type systems, and that's what RORO does, and I've heard hedge funds do this too. But they chart a ratio of the price of lumber to the price of gold. All right. When the price of lumber's blowing up, in relation to the price of gold. This fund, they buy, they do some kind of risk-on trade. I want to say that they buy stocks. And then whenever the price of gold is going up in relation to the price of lumber, they buy bonds. You know, and of course the theory is when gold's going up that bonds do better, but when lumber's going up, that generally means the economy's kicking ass, and you know you're building houses and building stuff, so you want to have exposure to growth assets. Okay, so risk on, risk off. They in the past quarter, I think they were up 29% this past quarter, which is great. And this past quarter has just been a face ripper as far as risk on goes, and they've been risk on. But if next quarter is different, in theory, if next quarter is different, they would switch from risk on assets to bonds and hopefully get their outperformance that way. So, but when you look at their performance, their 3-year performance and 5-year performance, they've underperformed, but they have outperformed this quarter. But this fund itself underperforming over the longer time frames kind of proves the theory of modern portfolio theory or indexing, or what Warren Buffett believes, that you can't really time the market, no matter how hard or how sophisticated your system is. But I do think RORO would be a good ETF for somebody that's worried about inflation, and I think that RORO could have a place in someone's portfolio. Okay, now I told you if you stick around to the end, I was going to give you the one fund that's an exception to this rule, and it's not a total exception, but it is a partial exception. BALI, BALI, the BlackRock fund that we've talked about before. They actually wrote a clause in their prospectus that none of the other covered call funds that I have seen yet have. And they say during temporary defensive periods, i.e. in response to adverse market, economic, or political conditions, the fund may depart from its principal investment strategies, which is selling calls, and invest up to 100% of its total assets in liquid short-term investments, including high-quality short-term securities. In other words, they're saying they can go to cash. That's what that means. If they have the ability to. Not only do the other covered call funds not have this clause in there, most of them have the opposite clause, or all of them that I've seen so far. All of the other ones say even during times of adverse market conditions, they're going to stick to their principal investment strategy, which in the case of QQQY is writing a put every day. It doesn't matter what they say. QQQY in their prospectus, no matter what they see, they're going to keep writing the put every day. They have less of an actively managed role. BALI has left themselves open where if we have a zombie apocalypse or something, they may depart from their investment strategies. But even BALI's not gonna like try to time the market and buy puts when they think the market's going to go down. If that's what you're into, there's other funds too, but RORO might be a good one to look at. I'm not joking. That fund really does. That fund does fascinate me, and I'm sure there's other ones that you guys know about where they try to time the market and get in, get out. I heard of one today, but I forgot the ticker. But my subscriber Charles is into a trend following type commodity fund. But BALI is the one that's kind of the exception to the rule. All right, and as always, remember this isn't financial advice. These talks are mainly for research. A lot of this is based on research I've done or just knowledge I've had from being involved in investing since the late 80s. And I like to give advice and stuff, but it's just a friendly advice. I could easily be wrong. I'm sure there's people with differing opinions that are also really smart and can back them up. So don't only listen to me. Go out there on YouTube and try to find somebody that has a different opinion and listen to them as well. Also, YouTube, the internet's a great place to do research and to get ideas as a place to start from, but it's not a place where you want to end up at. I appreciate you guys listening to this. I hope you liked it. If you did, like, subscribe, do whatever, and I appreciate it. I'll be looking for your comments, and I want to see what you guys think about indexing and modern portfolio theory and whether or not you can time the market. All right, have a wonderful evening.